Good morning, this is Joe Hoyle at the University of Richmond in Richmond, Virginia, where I've just given a final exam to my financial accounting class, and so I will be spending some part of the rest of the day grading that final exam. And I really do hope that you are enjoying this class and that you do as well as me and my students have done. It's been a good semester, they have done well, and I really appreciate the work they've put into the class. So I hope you're having as much fun, and I hope you're learning the material. This video problem discusses liabilities. More specifically, it discusses warranties. Now, we all know what a warranty is. You go, you buy a product. You buy a camera, for example, and you get a warranty. If the camera breaks, or if you buy a car, if the car breaks, then they will fix that problem within a specified period of time. How does this affect the company? Well, clearly, the company has a liability. They owe you a fixing of the product if it breaks. But notice, this is a kind of contingency. They're not sure it's going to break. They assume it will, that some of them will break. But it has to break first. If it breaks, if the camera breaks, they will fix it. Now, your uncle has called you, and your uncle runs a supply store, and they're getting ready to sell some new office equipment. And they have decided to offer a warranty with the new office equipment. Why are they offering the warranty? Well, that's an easy question. They are trying to make the customer more comfortable. If you buy this office equipment, you get this warranty, and because you get the warranty, if anything goes wrong, then we will fix it. So you might as well buy it because you're not really risking anything. It's a good way to make a customer feel more comfortable and therefore more likely to make the purchase. Your uncle, though, is very interested in how that will affect the company's financial statements. And to tell you the truth, this is a very important lesson. Many times business executives go to check what is going to happen if they do something as far as the financial statements are concerned. They don't want to make the company look bad. So it's always a good idea, before you do something new, to talk with the accountant to find out what the ramifications are as far as the financial reporting is concerned. Now, in this case, your uncle has two possibilities. One is they're simply going to embed the warranty with the purchase, and the customer gets the warranty right then. No questions asked, 100% of the people get the warranty. The accounting then is fairly simple. You have created a liability, and you have to recognize that liability based on what you probably will spend. So the company, your uncle's company, if they give a warranty on this equipment, should estimate what that warranty will probably cost them. So let's say, for example, that they think that the warranty will cost them $25,000. Because of the matching principle, that expense should be recognized in the same period as the sale of the equipment. So when they sell the equipment, they will also recognize a $25,000 expense and a $25,000 liability, because that's when they made the sale, and that is their best estimation of what that decision to offer the warranty will eventually cost them, $25,000. Now, it is just an estimation. So therefore, since it's just an estimation, it's likely to be incorrect. As soon as they find out that the number is something different than $25,000, higher, lower than $25,000, then they will have to change the liability at that point. So for example, if the next year they realize the liability is not $25,000 but $26,000, they'll have to increase the liability by $1,000 and recognize another expense of $1,000. I always tell my class, you always, when it comes to estimations, fix them when you find them. In other words, when you find out the estimation is incorrect. So you recognize the estimation in the first year as a liability, and then if that turns out to be incorrect, you fix it when you find out a better estimation. However, someone with your uncle's company has made a different suggestion. Instead of giving away an embedded warranty, This person wants to sell an extended warranty and charge the customer a little bit of money for the warranty to encourage them, but also make a profit. Companies that sell warranties are trying to help the customer, but they're also trying to make an additional profit. So let's assume that instead of giving the warranty away, they sell the warranties for $40,000. The item is still going to cost $25,000, but they're going to make a profit now because they're going to sell the warranty for $40,000. When they sell the warranty, they don't have the revenue yet. Why? Because the revenue comes from doing the work. The work is covering the office equipment. So when they sell the extended warranty, they will debit cash for $40,000 and they will credit unearned revenue for $40,000. It's not earned until the coverage has been made. Then later, when 25,000 of the office equipments are broken, they will debit the expense in that period and credit cash, and they will turn that unearned revenue into a revenue. It's not in the period of the sale, it's in the period of the coverage. So therefore, they will have a profit of $15,000. $40,000 from selling the warranty, less the $25,000 from fixing the office equipment. But that will be recognized in the period of the coverage because that's a different element of the earning process. So as you can see, an embedded warranty is handled one way. You recognize the expense and the liability immediately. An extended warranty is handled completely differently. You recognize an unearned revenue when you make the sale of the warranty, and then you recognize that revenue and the related expense at the time that you cover the cost of fixing the items. Your uncle needs to know that those two handling will be different depending upon which decision is made. And to tell you the truth, that's a very important element of accounting, explaining to a person how the financial statements will be different based upon the decision that's made. Embedded warranty, extended warranty, they sound alike, but the reporting is actually different. And the person making the decision, before they make the decision, needs to understand what that difference is going to look like, because that's going to tell how the company itself looks. This is warranties. We're talking about liabilities. This is Joe Hoyle at the University of Richmond. Study hard, do well.